Hi, Chris.
Hi, Cameron. How are you?
Yeah, well, mate. How's your day been?
Yeah, good. Lots going on at home.
Obviously.
Lots going on. Yep. Almost
Tell me more.
fully,
Tell me more about that.
almost fully pregnant wife and a child with what's the layman's term is school sores.
Oh,
So
is that what it is?
she's home, and yeah, it's juggling everything is problematic. Let's put that diplomatically.
Yeah, fair enough. Oh, it's a pretty exciting time, though.
It is. It is.
About to meet your second child.
Yep.
Which is
Very
at some
exciting.
point the next month, I guess. So.
Yeah, I think so. I think well, we were at the hospital yesterday. Statistically, any time in the next 2.5 weeks. So yeah, be good.
Forward to that. We're both at home today.
We
Chris
are.
has got his fancy background on.
Yes, well, that's so no one can see the Armageddon that is behind me. When you have a 3.5-year-old daughter who's been sitting on your lap, drawing, cutting, everything else, well, it's just an easier fix than having to actually clean up myself.
Welcome to life.
Yeah, exactly.
No feeling. Well, we've got one child with COVID at the moment, so he's perfectly fine and currently bouncing off the walls, and so hasn't had any symptoms. So hopefully that continues. Today's day 3. And then the rest of us, the other 4, are just now hoping we actually just don't get it, because then we'll be in lockdown for longer.
Yep.
Pending plans. But anyway, hey, we're doing our monthly market update. Economic update today. So there's a bit to talk through, and I suppose there's a couple of things that we wanted to identify and pull out. So why don't we scroll through some of this? So look, as you can see here, we've seen a fairly big spike in volatility over the course of the last, well, really since the start of the year, which is represented by these lines. So the VIX it's a measure of volatility, and volatility up and volatility down in financial markets. And so again, what you see here is we see that spike, it drops back down, and we see that spike again upwards of 35, and then drops back down, and we'll see that spike again. So there's lots of volatility in markets at the moment, and it's been challenging, I guess, is one of the words we could use there. In terms of world equity prices, and I suppose what's happened to equity markets over the last little bit, we've seen there that China's really dropped off over that period of time. We can also see that the S&P 500 has really fallen off. And the Aussie's sitting relatively stable. If you look back we're doing a May to April, so over the last 12 months. But it has been fairly volatile, again, as evidenced through some of those charts there. Do you want to talk through this one? This is fixed interest markets versus equities.
Yeah, and so I guess one of the things that when we're building portfolios, for people like yourselves, for clients, we're trying to create, I guess, offsets. So typically, the fixed interest part of the portfolio would be there to offset equity falls, and then vice versa as well, typically. So at the moment, just with the way interest rates are, and that the dynamic that actually plays, is we've seen a period for the first time in quite a long time that both equities and fixed interest have fallen at the same time. And so essentially what that means is that portfolio values and returns have fallen quite sharply. Now, I know I've had quite a few conversations with clients over the last probably month or two about this, or look, realistically, it's probably since Russia invaded Ukraine. that's kind of been, the headline discussion point. And it's really, I suppose, we had the Russia-Ukraine period during February, but what caused the concerns during January and then subsequently post the, I guess, recovery from the Russian aspect has been interest rates, and that's really what's dominating what's happening in the markets at the moment. And then subsequently, we are seeing some pretty, especially for those in growth or I guess in the higher growth portfolios, some pretty sharp falls. So you'll see on the chart here that the grey line there is the MSCI World share market excluding Australia. So, Cam's been talking about the volatility that's been jumping around. So you can see that clearly has higher highs and lower lows. But if you look at the trend line from, say, December, which was pretty much the high point, the trend line through that is obviously fairly steeply down. Now, the same can be said for the blue line, which is the global fixed interest index, essentially. And so, as I said originally just now, we would typically like those to move, not necessarily in exact opposition, but at least have some sort of offsetting mechanism, and it's just not happening at the moment.
Yeah, look, I mean, that's the case. This has happened, my recollection, once in the last 50 years, which was the bond market crash in 92. And so it might have been 93. And a similar sort of thing happened, but typically longer term, what we typically see is bonds offsetting or diversifying returns out of equities. And so this is just how it is at the moment, I suppose. Interestingly, also, what we've seen in terms of spikes here has been the US 10-year government bond has spiked, and so the yield on that back in what's called December was sort of sitting at about 1.5. That's doubled. It's already at 3%. And so, if you're a holder, if you bought, let's say you bought bonds in December 21 and you bought a 10-year government bond, US 10-year government bond, you only bought one of them, and you put $1 million into that and you got your 1.5. Now, in 10 years' time, the good news is the US government will give you back your $1 million. And along the way, they will pay you 1.5% each year. So it's very nice of you. Thank you, US government. The issue is now, though, and why we've seen fixed interest falling is because interest rates are now up at 3% on the expectation that there's going to be rate rises by the Federal Reserve. So as and when that occurs, if let's say another client had a $1 million bond that they just bought at 3%, if you wanted to sell them your bond at 1.5, then you'll have to lower the price that you'll sell it to them for. And that's the dynamic of fixed interest markets. It doesn't mean that there's lost money, because if you hold them to maturity, then the US government gives you your money back.
Yep.
It's just volatility in the medium, short to medium term. Yeah.
So all of this is really related to interest rates, and you would be hearing on the news about in the headline, either if you're reading headlines in the financial section, or maybe you're watching the news in the evening and getting to the finance portion, and interest rates would be dominating the discussion, and this is really why. So all the effect of these, so when Cam say yields are spiking, prices are essentially going down. That's kind of the effect that's happening. So that is all directly related to interest rates and expectation of interest rates for the, let's say, coming 18 months, 24 months.
Yep.
So yeah, effectively, there's lots going on.
Yeah. All right. Thank you. So it's probably not a bad segue. One of the reasons interest rates bond yields are spiking is because there's an expectation that interest rates will have to go up, and the Federal Reserve will have to put interest rates up, and the Reserve Bank of Australia will have to put interest rates up. And the reason that is occurring is because we're seeing spikes in inflation. Now, the Australian data, I think, came out, when was that, Chris? That was about 2 weeks ago, I think. And we were close to a 5. I know in the US, they're sitting close to a 9. In the UK, they got a 10 plus. print, which is all fairly significant. And so to curb inflation, generally what is required is for the reserve banks to increase interest rates to try and stop inflation. We can see here there's been a spike off a fairly low base, essentially back in COVID. Back here, this is Australian interest rates. We've seen a little bit of a spike there. I might just grab the inflation around the world. Yeah, all right. So it's probably a bit hard to see, but essentially we've seen spikes in US inflation, European inflation has spiked as well. The one that hasn't has been Japan, and that's I guess the concern and why we think why most market economists think that interest rates are going to rise as a result of that, because they want to curb inflation. The Reserve Bank's stated expectation is that inflation should be between 2% and 3% a year consistently, and clearly you want to have your growth rate higher than your inflation rate, which we don't have at the moment. When generally speaking, again, when reserve banks increase interest rates, it will reduce both inflation and GDP growth. So it has a double whammy effect.
I think one of the interesting things is that we'll probably get to later on here is that we've had artificially low interest rates for decade, maybe more. However long
it's been significant.
It's been a while.
Yeah, that's right.
And we need to get back to a point that is more normal, and that a lot of the monetary policy and fiscal stimulus that's been happening throughout, even post-financial crisis and during COVID, by its nature, by making things easier, the expectation is that inflation will lift, and I think that has been the intent of some of it, to increase output of the economy and keep people in jobs and all those sorts of things. So it's no surprise that there is inflation coming through. I think it's just coming through faster than most people expected all at once.
Yeah, agreed. One of the advantages, I think, of really low interest rates, and we did a session on this earlier in the week, it's been property prices, and particularly Australian property prices. So, I guess what you're looking at here is a fairly significant uplift in property prices over the course of the last year or so. And we saw that with average price growth last year being 21% across Australia. Yep. So having low interest rates has helped kick that along. Now, anecdotally, that's starting to turn around. And obviously in Darwin, we've seen a reduction in prices. Just try and pick that one. Which one's Melbourne? I think that's Melbourne there. A slow reduction in prices as well, coming off a higher base. So that's it's interesting. And whether that continues or not, it's probably another podcast or video cast, whatever we're going to call this. The other thing to probably point out too is so this is the US equity market since 1995. Two things to call out here. The first one was how quick the COVID fall was. You can see that within a month it was a 35% reduction in asset values in US equities, and that covered within it was about 4 months, I think, Chris.
Yeah, I think I had 50 something days, whatever that is.
Yeah. And this is where we are almost 2 years later. Again, put that down to a lot of things, but part of that is reducing interest rates, and so subsequently more company profit being reinvested. Is there anything else we want to cover off on the economics? Is there anything else that you wanted to call out?
Not really, not from this end. I think it's just important to let everybody know, I guess, the dynamics of what's happening at the moment. And specifically, just in terms of, what does that mean for things going forward? So, as I kind of talked about earlier, my expectation is that through this period, we need to, or the Reserve Bank and the Fed and whoever the ECB, whoever it happens to be, kind of need for their policy tools that they have in the bag for interest rates to get back to a more normalized level. So that if we do go through a recession, which I guess is the concern out in the marketplace, as a product of this, inflation gets out of hand. Reserve banks around the world have to increase interest rates faster than expected, which therefore causes a recession. So to Cam's point about reducing GDP, for example, so that's the technical measure of a recession, 2 negative GDP quarters. So if there's a recession, then obviously things in the economy aren't going as well as possible. And then typically what happens during that period is the Reserve banks then lower the interest rates to provide stimulus to the economy. So if we don't have interest rates back to sort of more normalized levels, it doesn't give the central banks any tools to pull when we go through a recessionary environment into the future. So there's an element of this that rising interest rates aren't necessarily a bad thing. It's just a matter of, well, how quickly do we climb and what does that do to asset prices in the meantime? And at the moment, it feels like there's a bit of, well, overreaction, I guess, going on in the financial markets about how high interest rates will go and how quickly. But, you know, we're, as we will always say, kind of within the equity aspect, you know, hold tight because these things happen every 2 years or so.
Yeah, very often. And probably to that end, so as you would all recall, because it's fairly consistent through all the conversations we have around investing, we think that the best way to keep capital over a long period of time is to have a diversified investment approach.
Yep.
And to that end, we're looking to further diversify the portfolios at the moment. So what that essentially looks like is there'll be a slight increasing to the allocations that we currently have to infrastructure and property within equity markets. And we're going to take some of that weighting from both a small part from Australian equities and a little bit from global as well. Not a really significant change, but you know, we're just looking to add in some additional diversification.
Yep.
Which, you know, as you will all know, we access those, particularly those growth markets that are highly liquid. We access those through low cost diversified ETFs. So that's one of the first changes that we're looking to make, and that's been on the cards for a while, and that played out at our investment committee just recently as part of the inputs to that. And I suppose the second part of the change is we're looking to make some changes within the fixed income allocation to also reduce, I suppose, the duration, what's considered the duration or the maturity profile of the fixed income portfolio. So typically that currently sits at about 6.5. So the 6.5 being 6.5 years. We're looking to bring that into around about that 5 and about just tick over 5, I think.
Yep.
Which will still mean that we're just starting to play on that yield curve a little bit and bring it in a little tighter. And we're going to access that through a number of different vehicles, but most likely managed funds. So, Chris, is there anything you want to add there?
Yeah, I think in terms of, I guess what we're trying to achieve as part of these changes is that there's a recognition, and as I've probably, this will be the third time I speak about this, there's a recognition from the investment committee that interest rates do need to continue to lift. And so if we maintain the portfolios as they currently are, there's some, I guess, downside risk that we don't think we want to leave you as clients exposed to, but we don't really want to change it too heavily. So by bringing in, I guess, the technical term we're kind of calling that duration, or it's effectively like what's the average length of the bond, or I describe it to clients in terms of like a quasi-term deposit, how long the length of that is, and then therefore how interest rate sensitive your investments are. Bringing that in reduces some of that downside risk, but then also as a byproduct of that, with the reallocation, we're actually increasing the income that's generated from that part of the portfolio, which will hopefully offset, I I guess, some of what we've seen and some of what we might generally expect to pick up, say, over the next 5 years. So it's really twofold, about reducing the risk of the portfolio, but then also increasing the income side of things, and better preparing ourselves for looks what is like an inevitable march forward up in interest rates. Because if we look at the return, I guess, profile over the next 5 years forward, the returns are pretty clearly asymmetric. So, we look at that and say, we need to make sure that we're doing the best thing in the interest of our clients. And obviously that's why we're making these changes.
Yeah, really good explanation, mate. That's great. I think expect, and these are expected return numbers on the income side of that fixed income portfolio, but we're expecting returns of about 4% a year on an ongoing basis. Now, whether that, as we all know, whether that actually hits the accounts or not, it's a different thing. But that's, I guess, what we're expecting. So it's pretty interesting though, because a couple of years ago, an expected return, or a year ago, an expected return of 4% out of fixed income, out of bonds, would just be. And this gets to the other point as well, that the upside of interest rates going up is that there's actually more interest paid.
Correct.
So I recall about a year ago, the 10-year Aussie government bond was sitting at about 0.8, 0.9, so a 0.9% return. Now that's significantly higher, 3 times higher than that now. So,
which is good good for most, I think, especially if inflation's going up. We need some return to help offset the inflationary effect.
That's right, exactly. That's the disclaimer, everyone. So no personal advice there, all general advice. Don't act on it. Come and see us, please. Is there anything else that we want to finish off with, mate?
I don't think so. I think in terms of just from the clients, a lot of the clients that I deal with, how we action this, you'll probably hear from me, or hear from us rather, in terms of being able to action this, and we'll make the changes as we need to on the way through.
Sounds good. See you, Chris.
See you, Ken. Thanks for your time, everyone.
What are you cooking for dinner tonight?
My brain hasn't even computed past that just yet. I'll we'll see what happens when I decide to think about it.
You got me onto HelloFresh a couple of years ago, and the HelloFresh box arrived today. So
yeah, nice.
I'll be accessing some recipes from there.
Funnily enough, I got an email this morning from one of our ethical investment firms about a deep dive into HelloFresh as a company.
Oh,
so
really?
I haven't had a read as yet, but
okay, interesting. Yeah, let me know, please. You might be getting me offered tomorrow. Not casting aspersions, eh? All right, I'll see you soon, mate.
Thank you.
See you guys.